Today, we are going to take a sneak peek behind the curtains, think Alice in Wonderland type scenario to see what's happening in the Toronto real estate market. My name is Ralph Fox, and I am the co-founder and broker of record of Fox Marin Associates. Please be sure to hit that like or subscribe button. Today, we have none other than friend of the pod, Steve Keyzer, joining us. Steve is the team lead at the Colliers Redevelopment Advisory Brokerage Team, and Steve represents a number of private, public, corporate, and institutional urban real estate landowners. And Steve and his team specialize in maximizing the value of properties for their clients. Value maximization and the redevelopment process is what Steve focuses on every single day in central and downtown Toronto. And he's here to give us an inside peek as to what's happening beneath the facade of the Toronto real estate market, which might help indicate where things are going. Steve, so great to have you here.
Thanks for having me. Happy to be here.
Awesome. Okay, so let's talk about the current residential land market. What are you seeing right now, Steve?
Really, 2021, 2022 were the peak in terms of transactions, not surprisingly, with cheap rates. So 18 billion and 16 billion respectively for redevelopment land in those years. Things tailed off in 2023 to 6.4 billion. And then year to date, it's been under $1 billion. So
under $1 billion this year.
Yeah. So wow. It really is a reflection of developers' confidence, to keep buying land. Really, when things are selling and products moving, they keep buying land. So it's a sign that the front end, their sales are really slow. So they're not buying land and their pipelines are effectively frozen.
I've seen that we're like 90% below the 10-year norm or average in pre-construction sales. So that's not just affecting us at the front level. That's all. You're also seeing that with $1 billion sales year to date on land transactions.
Yeah. And it has to do with the developer pro forma. When, they look at land that they own, they're sitting on unsold units. There's probably a 3 to 5% default rate on projects being delivered currently. And so they're dealing with those. And, when they run the numbers on where they think they can sell product now, there's not enough margin. So they're holding. And in order to hold, they need capital because there's land loans in place and there's other operational costs of their business. So they're not putting that money into land. They're putting that money into playing defense, not offense.
So is everything just really on hold right now until things resume? Is that sort of what you're seeing?
Yeah, more or less. I mean, there are buyers out there. I mean, there's a lot of developers in Toronto that have well-heeled capital, but it's got to make sense. And the numbers have to make sense in today's market, notwithstanding people may be optimistic about the future because there's no product being built. There is going to be a shortfall in 2 to 3 years because nothing's going in the ground. So notwithstanding that, developers underwrite with today's economics because you can't predict that revenues are going to go up in the future because costs could do the same thing. So you're really taking a snapshot of today's market when you're buying land, and then you're taking risk from there.
And what are you seeing, the trades that you are seeing? Like, what are you seeing buildable per square foot right now?
Well, in the high, we sold a site at Charlotte and Adelaide at a receivership. I remember it closed July 2022, just before the interest rate hike started.
Yeah.
And we sold that site and another one at Peter and Richmond at in around $300 a buildable square foot.
Right.
Today, you're probably looking, depending on the location, anywhere from $100 to $150 a buildable square foot.
That's a big drop.
It is. It's more than 50%, and that's why I'm screaming from the rooftops. Like, land has never been cheaper relatively in Toronto.
Yep.
And I think that in 3 to 5 years, there is going to be recovery, but buyers are cautious. Vendors are still optimistic because 24 months ago, those were the numbers, or 2.5 years ago. And so they're rolling the dice and they're saying, I'll see the next hand and we'll see what interest rates do. But interest rates have not come down as fast as they would have expected. Mm-hmm. So you're seeing a little bit of capitulation on the vendor side. And that includes, you have a bunch of receiverships and banks. Various banks are okay. Various are, they're first position land loaned. They're not getting full recovery on. So, we haven't dealt with this since the early 90s, and most people in the business weren't in the business at that time.
Yeah.
So they really don't want to take this bad news upstream and say, we got to take a loan loss here. So they're rolling the dice, a lot of them, but some of them are capitulating now and realizing this is a medium-term slowdown, not a short-term slowdown.
And so it sounds like we're at a bit of a stalemate right now, because $1 billion, dollars sounds a lot, but in the world of real estate development, that's not a lot of transactions. By way of reference, in a matter of years, going from 18 billion now to 1. And it seems like because pre-construction sales and demand, which what drives the market, are basically at a standstill as well. It sounds like the whole development world, from the front end sales to the bottom end sales, it seems like we're basically at a standstill. Is that correct way to look at that?
Yeah, and if I'm a young buyer and I have some money, I would say now is the best time you will have in probably the next decade or longer to get into the market with condos, with the assignment market, with product that's being built and completed and unsold.
Mm-hmm.
I think you can negotiate right now. So,
can.
Notwithstanding, you may have not expected interest rates to remain this high. I would buy on a 1-year mortgage rate, get a great number, hopefully, depending on the situation, and then refinance in 12 to 18 months. So I would be aggressive and in the market right now, but that's not. It's a herd mentality on all sides, being individual condo buyers and land buyers. Once it's on. But right now it's not on. And so if I'm a buyer of both, I'm being aggressive.
Goes back to Warren Buffett. Old adage,
exactly.
right? Be greedy
That's
when
right.
people are fearful, and fearful when people are greedy. And it takes a lot, whether you're looking to buy that first property and swing a $700,000, $600,000 purchase, or a $500 million purchase to pony up when there's blood on the streets, when everybody is nervous. And it seems like a real easy thing to do, but yet with emotions and uncertainty, and is this the true bottom, or could there be another leg to go down? There's a lot of fear. And it's interesting just thinking about this conversation, seeing it in context. It seems to be no different in a lot of ways. A first-time buyer versus you sitting down with a very large experienced developer screaming it's $125 buildable a square foot. What a great time to get into an opportunity. And so it seems like right now this is happening just across the board, which is really interesting when you think about it.
Yeah. I mean, Stephen Schwartzman, the founder of Blackstone, if you haven't read his book, you should get an Audible too.
Book.
But he always talked about, I always get in the market when it's recovered by 10%. Right? You don't want to call the bottom. And I feel like everyone is imploring that right now. They don't want to catch a falling knife, or, buy and then it gets worse. But I would think you're kind of insulated, even if it gets a little bit worse. It can't get much worse, in my opinion, without government incentives and government intervention. So I would say we're at or near the bottom. Maybe it goes down another 10%, but I don't think it can go any lower without the government stepping in and taking real action. Because the incentives that have been put in place recently, they're just for headlines. They don't really move the needle, because we're running the numbers every day on these development sites. And the recent announcement on DCs, they're waiving DCs on rental, but
for
development charges.
Yeah.
But they're requiring 20% affordable housing in exchange for those DC waivers, which basically maybe puts you a little bit ahead on the pro forma, but it's not earth shattering in terms of creating the real margin that is required.
Someone's going to have to pay for the affordable housing. That's the issue. And the government's just trying to offload those costs. So it is really interesting to see this happening across the board, knowing, you would have resale being the first mover that's going to see things open up. Pre-construction sales will follow resales, and then the development world will follow. What we're seeing on the resale side of things is we're definitely seeing a slight uptick. We're getting a lot of buyers now actively looking with the belief that there could be an uptick as we head into the spring market into 2025, with more interest rate reductions coming. So we are starting to see a little bit more confidence in first-time buyers starting to move. And after the elections, and we've seen this before in past election cycles in the US, where people aren't really thinking that they're not going to buy or wait till the elections are over, but their intentions start to become a little bit, or their focus starts to become a little bit distracted. And we've noticed on the other side of the election, with rate cuts and policy changes coming down the pipeline, that there does seem to be increased activity. We saw property on the East End get 18 offers and sell at a very elevated price, which surprised everyone on our team. And this was just last week. So we are starting to see that start to happen. And I think once resale starts to front run, you'll see the other aspects of the market start to come behind it. But it's going to take time for sure. But I do think on all levels, if we aren't at the bottom, we're very close to it. And from a resale perspective, residential resale perspective, we're probably going to start climbing soon.
Yeah, I thought I saw stats that said the resale market, actually single detached, was up year over year, if I'm not mistaken, right? Which, if freehold, detached, or semi-detached homes keep going up in price, notwithstanding the current interest rate environment, that's going to continue and get even stronger. And so that's going to create a relative discount, I guess I could call it, to what you can buy a condo for. We can buy a 3-bedroom condo for versus a 3-bedroom house. If you have to spend 1.7, 1.8 to live downtown in a 3-bedroom house, and you can buy a 3-bedroom condo for 1.2, there's value there, right? So I think, to your point, once the resale market absorbs all of these units from the record deliveries, I think probably in 12 to 18, maybe 24 months, then we're going to have housing crisis again. And so that's really the sleeping giant, is that things have been stagnant for 2 years on my side in terms of starts. Even the biggest names in the industry can't sell condos. Doesn't matter who you are or where it is. There has been some success in the 905 in the last 12 to 18 months, but it's price point. It's $1,000 to $1,100 a square foot. So it's a value play. So to get back to the $1,300, $1,400, $1,500 a square foot, it's going to take time.
100%. And the market just generally tends to work in gaps. So you have a gap between low rise and condos. And as low rise starts to increase based on affordability, when low rise takes off, you'll start to see condos, as that gap widens, start to elevate. Then you'll see the pre-construction, and then you'll see development. And it's a real question of when this gets unlocked. But I do agree with you. We are in a ticking time bomb with the condo market, because yes, there's a bit of a hump with deliveries for, as you were saying, the next 12 to 18 months. After that, I've seen the charts. I've seen projections for 2028, 5,000 condo units coming online for the entire GTA, which is just insane. And then after that, it gets even lower. So it's one of the things counterintuitive to a lot of real estate agents in terms of what the generalization is we're always pushing people to sell or buy. We're telling all our condo owners, we ourselves, as condo investors, we aren't selling, because we know what's coming down the pipes a few years from now. And I think if you're watching this, whether you're a homeowner, whether you're a real estate investor, whether you're a developer, what we are seeing, boots on the ground, and when we look at the data, is Toronto has traditionally been very, very starved for inventory, from land to condos to houses. And while we're not there in this environment, if you look down the road, it's very clear what's coming down the road. And I think it's really important to be able to anticipate what's coming just as much as it is to understand where we're at right now.
The one thing that's changing on the policy side is, with the provincial government, is more density around transit. And so you're going to start to see around the new subway lines or the Eglinton LRT, once it opens, is more sites clustered around those stops and higher density around those stops. So where traditionally the below-rise neighborhood, those are likely going to get an official plan amendment to change from neighborhood to mixed use. So you're going to start to see more sites in the pipeline. And then with the recent city announcement on mid-rise guidelines and as-of-right zoning along the avenues, 6 to 11-story tall mid-rise buildings along the avenues. So I still feel like those 6 to 11-story projects, the margins are still thin on those, and you can't really pay a big enough land value to incentivize these owners to sell along Queen Street and Bloor Street or Danforth. But it's a step in the right direction. So I feel like from an inventory perspective, there's going to be more than there ever was. And really that brings down land values as well. Because with more product to build, developers will then choose where they think the best locations are. And everything else, goes down a little bit in price. So there is, some structural pressure on land prices and development land prices, but that's all corrected by proper revenues, and that creates the residual land value to incentivize owners to sell and create value over their existing asset value. So it is a multifaceted market with many variables changing at all times. But I think that, as you're saying, in the next 12 to 24 months, I would see a huge amount of value in buying, because after that, the numbers are going to go up. And so if you're an investor or an end user, I would get in the market right now. Be greedy.
Right now. There's that other quote by, I think it was Templeton, was, buy when there's blood in the streets, even if it's your own.
Right.
You look at like every successful investor, or most of them, or companies, they all were founded in recessions. And this is when the great opportunities are. I know I see this at the brokerage level. I'm sure you're seeing it as well. It's such a great time to grab market share while other people are falling out of the business or contracting. It's always best to expand during a time of contraction as a contrarian. That's where all the opportunity is.
Absolutely. And just look back 30 years ago, how many development companies were started then? Like some of the biggest names in the industry. And so it's just been a 30-year run with a couple blips in 2008, a little bit in 2017 on the land side. But the longer the cycle, the longer the recovery, typically. So there are going to be massive opportunities coming out of this. So it's exciting. It's terrifying, but it's exciting.
Excitingly terrifying. How's that? It's interesting though, because, and I talk about this, I'm thinking about this a lot. If in 2019 you and I were having a drink, toasting New Year's, and I said, okay, 2020 is coming, Steve, and this is what's going to happen. We're going to have the largest pandemic since 1917. The world is going to shut down. We are going to have a foreign buyers ban, and we're going to take interest rates and we are going to take them from zero essentially, and we're going to raise them 500 basis points in 18 months. And we're going to throw a whole bunch of tax increases and a lot of policies that are unfriendly to investors. What will the Toronto real estate landscape look like from a price standpoint? And you would think it would have been Armageddon. Like really,
Yeah,
you would just think
absolutely.
it would be Armageddon. And when you look at detached and semi-detached prices and you see, oh my gosh, we are almost near the record highs. When you look at condo prices and see that we're about level to where we would have been in 2019, yes, it went up and down, but we're level pre-pandemic numbers. It's pretty crazy to have seen how resilient the market has been, at least up until this point. Like, are you surprised by the resiliency that we've seen? Let's just say even from the development side.
Yes and no. Like, I mean, look, from 2004 to 2008, interest rates were at 200 basis points, and it went up to 450, right? And then really, it was after 2008 we got the cheap money. And so historically, and talking over a longer period of time, interest rates aren't zero. And so this is a more normalized market, probably somewhere in the 2 range, where hopefully things rest next year. So our market operated quite well for a very long time with more elevated interest rates. And so I think it's just finding the equilibrium again, where investors see value, developers see margin, but until things level and everyone kind of knows the variables, and is comfortable and sees value, we're not going to see the new development. But certainly, on the condo side, there's projects that are just being completed now that sold at $1,100 a square foot. So it wasn't too long ago, right? And you mentioned that things did spike. But again, going back to your point on the resiliency of the low-rise market, there's just no new low-rise housing. So that's going to continue to gain value. And the really, for some, the only way to get in will be the condo market. And that hasn't changed. And so I think once things do get absorbed in the condo market, I think you're going to start to see a run up in prices again, probably in 27 and 28.
And do you have a lot of experience in the purpose-built market? Are you trading? Are you working with clients there?
Yep. We just completed a large deal with the city, actually, at 610 Bay. That was a 99-year land lease to Tricon in Kilmer. So we just announced that last week, and the mayor was there. So we've analyzed these pro formas as well. They're very skinny margins. You're building to a 5% yield, right? So, it's typically pension fund back or long-term money. This is not the, making the margins that condo developers make. This is a thesis. It's a long-term investment. And, you're lucky if there's margin on a rental. Once you take out your construction loan and put in your permanent financing, typically there's not a margin there, but you're building to a yield. So with the more incentives, with GST and HST being removed from rental last year or at the beginning of this year, and hopefully some more work on DCs to remove the affordability or at least reduce it or have credits against the affordability component of it, the numbers will make more sense. But really, the recent announcement that I said earlier, they haven't moved the needle on rental. So you're still seeing projects that are stalled. The project we did at 610 Bay worked because the land increment was adjusted to reflect a proper margin for the developer. So it was a win-win for everyone. But the private landowner is not going to sell their land or lease their land at significantly reduced numbers to make the deal work. On a market basis, again, more incentives are needed, and they've fallen short so far.
We're seeing a lot of purpose-built projects struggling in the market right now. I know when they penciled their pro formas 3, 4, 5 years ago, their projections for rent and the premium that they would be getting above market for having all of the amenities and professional management that they have, it's just not making sense right now. And we see a lot of them struggling to try and get that premium above market rates. Are you seeing any of that play out?
Yeah, there is a premium to rental versus condo rental. I say purpose-built rental, but based on the latest stats, condo rental rates on average $3.69 per square foot per month, and purpose-built rental is at $4.17 per square foot per month. So you are seeing a value increment for the, full-size appliances, higher quality finishes and amenities.
But they're struggling.
But yeah, average rents are down between Q3 2023 and Q3 2024. So you're starting to see a leveling off. And so that has definitely softened. And when you're putting rental numbers in your pro forma, and you're going to CMHC for financing, a lot of developers are putting pretty aggressive rents in there, but I know they're getting knocked down by CMHC. That and cap rates when the buildings are completed, CMHC is increasing those. So notwithstanding they're touting their MLI Select program, which is 95% loan to cost, your effective loan to cost is probably closer to 80%. So you're still having to put in a significant amount of equity, again, for a 5% return on cost. So it is still very skinny there. So it's not like that's making a ton of sense, and that should fill the gap. And I think that's the intention. And when you're seeing the policy come out, especially at the city level, they're incenting rental. They're not incenting condo. So all these incentives do not apply to condo. And condo developers are sitting there saying, well, we're part of the solution too. We have been the only solution, more or less, for the last 20, 30 years. So, but it seems as though that the city at least has picked rental.
Do you have any data on the vacancy rates of purpose-built right now? Because we're getting approached all the time for all these empty purpose-built rental buildings right now.
So in the GTA, purpose rental availability rates in Q3 was 11.9%.
Okay.
And so a lot of that has to do with the fact that there has been a lot delivered.
Yep.
Because it really only started 3-4 years ago, like in a big way with Fitzrovia and Tricon and Quadreal really building. And so a lot of that is just the fact that it's new product. It does take 12 to 18 months for absorption. So, what you're seeing during COVID or at the end of COVID in 2022, the availability rate was 6.7%. So It's just a question of more deliveries and more absorption being needed. So it's certainly, not as quick as probably they would have expected.
Yeah, because I think they're too expensive for the market right now. That's what I think it is. So it'll be interesting because it seems like there's more downward pressure. A lot of people are staying at home or moving back home with all this uncertainty. So it's interesting. I'm watching all this play out in real time. And then the other thing that I think about often is policy risk. Like, what if rent control comes back? Maybe there'll be an exemption for purpose built, but at the same time, if there's a shift in government provincially, I could definitely see full rent control coming back.
Absolutely, and that's the golden ticket right now in terms of core real estate investing, income producing properties is buying rental buildings built after 2018 because you're not subject to rent control. So every investor, you're hedged against inflation, you're hedged against rental risk, rent rate risk, and so if you're going to buy something, that's one of the best assets you can buy right now. But until
under a liberal provincial government or NDP provincial government, I could see that changing very, very quickly.
Absolutely. So that is a big risk.
Where are you seeing the market going, from a buildable per square foot? Do you think we'll go back to that 3,000 kind of number?
Sorry, I mean, look, 300. Yeah, it's. I don't think we're there for a number of years. It's really hard to predict because we've just been drinking the Kool-Aid for so long. And after 2008, the U.S. it took 10 years to get back to pricing levels where they were. Right. Yeah. So, it's so hard to predict, and I think people are optimistic that it will. But the investor, and I've spoken to people like yourselves and others in the pre-construction world, it's just investors don't see the value right now, and so until they see the value,
there is no value there right now.
Right. So until that happens, you're not going to see price growth on condos, and therefore land is a complete residual. For every $100 in revenue in a condo project, typically it's $50 per square foot of land density. So until we see the $1,500, $1,600 square foot again, you're not going to see $300 buildable land.
And so you'll need to see the condo market trading at 13 to 14 resale to push up value.
Push up the premium.
Because the problem is, and most people don't understand this, is with development, their costs are very fixed and only going up. And so even though they want to sell inventory, unlike other market participants, they can't reduce their prices because they're capped, essentially, how low they can go.
Absolutely. And I think at the height, we saw over $400 square foot gap in resale and pre-sale. And so it's got to get back to that 100 to 150 maybe premium. And so you're right. So 13 to 1400 on the resale, and then you're back to that. So how long that takes, who knows? This market does surprise me in past, I call them mini cycles. Mm-hmm. But we'll see.
We're probably a year, 2 years out from that, I would think. Optimistic. But it will come. It will come. Okay. Last question I have for you. Actually, there's two questions I have. If you were on this platform, or let's say at a social engagement or event, like if there's one thing that you wanted people who weren't familiar with how the development world works, if you would want them to know, is there anything that you would want people to know? Because a lot of people, like off the top of my head, have this idea that developers are really greedy and they make all this margin. And that really isn't necessarily the case when you start to look underneath the hood and get privy to a lot of conversations and even get to see pro formas. But like from your side of the field here, like what would you like people who are watching here today know about residential pre-construction from your side of the world that they may not be aware of?
Really, the biggest thing that we provide to our clients is we pull up a pro forma in front of them. So it's not a simple answer. I can't say, well, costs have done this, or the underground here, the soils are bad, so you need to do deep pilings, and it's going to cost an extra $10 million. Or it's a skinny floor plate, so your efficiency's down, so the building really doesn't make as much money as it should. So there's very technical answers to that, and it really depends on the site. And if you go through a pro forma, you put revenue in, you put cost premiums, you put all the municipal fees, you put a developer profit, and then a land residual, you will see that, yes, some projects make a lot of money, but if you look at the risk that's involved,
Oh my God.
a developer recently said
And the
to me,
variables.
the constantly moving variables, which
Yeah.
it's 7 years of work, right, between
It's crazy.
unzoned and finishing, and so much can change in those 7 years. And a developer said to me a couple of weeks ago, he said, "You wouldn't believe it, but most developers, you take 5 projects. 1, they knock it out of the park. 2, they make a little bit of money, and another 2, they lose money." So it's not as good as people think it is. If you have multiple projects, you're probably doing well. But a lot of developers go one project by project, and it's very hard to pull off in today's environment. So I would just say that it doesn't matter who the developer is. Every project needs to make sense, or they're not going to invest. It doesn't matter if they're a wealthy family who's been in it for generations, and you can't stick it to them on one project because they won't do it. And so I think that's the mentality, is that developers make gobs of money on every project, and they'll just absorb these costs. They'll absorb the development charges, but you run the numbers, and if it's a negative return, no one's going to do it. So you have to incentivize. And most developers that are in the market now aren't wealthy generational families. They're living project to project, and they need to see margin to take risk. But with the variables now and how unpredictable they are, no one wants to do it.
And then you have like Olivia Chow saying she's going to build 10,000 residential units. And to anybody who is thinking that this is a good idea, I just tell you to look at the Eglinton Express extension and how that went. Government is not the answer for sure. They're a partner, and they can help stimulate and they can help provide solutions, but government is not the ultimate partner. And if there's not an opportunity to make money, the private sector just won't get involved. So
exactly.
It's a very complex issue for sure.
It is. And I think what I saw with 610 Bay, 130 Elizabeth, the partnership between Creatio and City and Tricon, that was a win-win for everyone. So amazing. Bringing in the private sector, creating the margin, deliver on their goals of affordability and market and other requirements, you can make it work, right? Just that the city has to be a partner in it and bring in the right group that can deliver. But city building on its own, I don't think that is something that we're going to see. I think you're going to continue to see partnerships, which I think is the right thing to do.
For sure. I've been into some of the city-owned properties that they put up for sale. Yeah, I don't even think they should be managing properties, but that's a whole other story. Steve, thank you so much for joining us. One last question. Price prediction, 1-bedroom condo, 2030. Give me the price.
Okay, 1-bedroom condo, 2030. There's going to be really no deliveries for the previous 3 years.
Yeah,
I think we're probably somewhere between 1,400 and 1,500 a square foot.
So that would put a 1-bedroom, let's say 600 square feet, around 900,000. Okay, there you have it. Steve.
I hope it's higher.
I think $1 million. I just say a blanket million.
Okay, there we go.
But that's my working thesis, and whoever watches this and has an idea of their own generally does not like when I say that. But I think 2030, I think we'll see a 1-bedroom condo in downtown Toronto hit $1 million. So
I would not be surprised.
Yeah, watch our comment section blow up after that statement. Steve, thank you so much for joining us. So great to have you on the Toronto Real Estate Podcast. Once again, my name is Ralph Fox. And if you like this content, please be sure to hit that like or subscribe button. And if you have any comments, as long as it's constructive, please be sure to comment down below. Steve, if anybody wants to get in touch with you, where would they find you?
steve.keyzer@colliers.com, Keyzer, is an email. That's the best way to get a hold of me.
Awesome. Steve, thank you so much for joining us.
Thank you, Ralph.